As a stock investor, sometimes it may be hard to know what type of stocks to buy, which industry is currently booming for you to buy the stocks, or to just get started in general. And I always see people on Facebook groups saying, hey guys, I have 1,000 rand to spare, can you please recommend which stocks for me I can buy? And people will either say, okay, buy this type of stocks, and some other people will always say, just do your own research, which is a very good advice, but they don't actually tell people how to actually do a research before buying a stock. And by doing proper research on a stock or a company before you buy it is very important, because either it can make you lots of money if you start doing it, and secondly, you can actually lose a lot of money in your portfolio if you neglect doing it. And a lot of investors actually avoid doing this step because first they feel like they don't know where to start researching, and secondly it's just as simply lazy to do the research. So in this video I'm going to be talking about the 5 most important basic things to do before buying a stock, or the 5 most important things to do or to research before buying a stock. And I feel like these are the most important things that each and every investor or each and every beginner should know before actually starting investing. And actually this is the kind of information that I wish I knew before I actually started investing. Number 1, research a company fully. As an investor, you should avoid purchasing any kind of stocks or investors unless you have all the answers and knowledge to questions like how does the company actually make money, what does the company manufacture, what kind of services do they offer, in what countries do they operate, what is the company's flagship product and how is it selling, and lastly, are they known as a leader in their field? And if you can probably answer all those questions, then you're probably ready to buy the stock. Well, think of it as a date. You probably wouldn't go on a date with someone you don't know or don't probably have an idea of who they are. And if you actually do that and proceed to go on a date with someone you don't know, you're actually ignoring all the red flags and also potentially putting yourself in danger. And the good thing about all of this is that you can find all the answers that you're looking for when you just go on your search engine of your choice. You can just go on Google and just type in the website of the company that you want to research on. Maybe let's say you're looking for Tuna Resources and you want to buy Tuna Resources, then just simply go on Tuna Resources website and just answer all the questions by looking at all the things that they actually provide for you in their website. Number 2, price to earnings ratio. So imagine for a moment you're in the market and you're looking for somebody who can actually help you out with your investments, and then you start interviewing 2 financial advisors. So the first financial advisor is a proven track record of having wealth for other people and actually creating lots of money for people, and even your friend has actually seen a lot of return on investments when he was actually working with the first financial advisor. And you can also see a reason why you can't actually trust this person with all of your investments and all of your money. And then what they say to you is that for every rand that they make for you, they're actually going to take 40% and actually going to be left with 60%. So the second financial advisor that you just interviewed says that they just started out in business, they have little to no experience, although they seem promising, and also they don't have a proven track record of success because they just recently started out. But the only advantage of investing with this second in financial advice is that they are cheaper and they just want to take 20% of every rand that they make for you, leaving you with 80%. But the only thing that will be lingering in your mind is that what if this second financial advisor doesn't make much more money compared to the first financial advisor? So if you understand this example, you probably understand the price to earnings ratio. So these PE ratios are used to measure the company's current share price relative to its per share earnings. The company can be used and compared to other similar corporations or other companies in similar industry with the other company, so that investors and analysts can actually determine the company's relative value. So if a company has a PE ratio of 20, it means that investors are willing to pay 20 rands for every 1 rand per earnings. And this might seem very expensive to actually pay 20 rands for every 1 rand per earnings, but also there's an exception to this, that if a company is actually growing very fast, some investors are actually willing to pay that amount of money. And the PE ratio can be found by comparing the current market price of a company or the current share price of a company to the cumulative earnings in the last 4 quarters of a company. For example, let's check 2 mining companies which are in the same industry. For example, you're going to compare Anglo American Platinum and also Impala Platinum. As you can see, there are 2 major differences compared to their PE ratios. One is a higher PE ratio and one is a lower PE ratio. So what that basically means that if a company has a higher PE ratio, it means that there are also reasons why the company's PE ratio is high. You can also find that out in their news. And also, if the company's PE ratio is low, it means that the company is actually not doing well. But there's also an exception in that. If the company's PE ratio is low and the company is actually growing fast, that's a very, very good company to actually look into. And please note that if you want to compare companies according to their PE ratio, you need to compare companies in the same industry. For example, you have to compare Impala Platinum with Anglo American Platinum, and also you just can't compare Anglo American Platinum to McDonald's because those values are not the same and those are not the companies in the same industry. And also, if you want to know more about the PE ratio and how a PE ratio actually works, then I highly suggest you to watch this video right here, which can actually help you to learn more about how the PE ratio works and how you can actually use it to your own advantage. Number 3, beta. It actually seems like something very difficult to actually understand, and it's actually not. It actually measures the volatility or how moody your company's stock has acted over the last 5 years. It actually measures the systematic risk involved in a company's stock compared to that of the entire market. And you can always find the beta values on the same page as the PE ratios every time you're doing research on stocks, and especially on papers that are found on Yahoo or Google. So how this basically works, that for example, let's say that is a benchmark which has been set up to place to measure how high or low your company's beta is, and then maybe let's say the benchmark is S&P 500, right? So it's actually going to measure how high or low your company's been going for over a period of time. So if the company's benchmark or beta is actually higher than the benchmark, it means that it has a higher beta, and if the company has a lower beta than the benchmark, it means that it has a lower beta, and everything that is greater than 1 in beta, it means that it's higher, and if it's higher, it means that the company has a higher risk, and if the company has a lower beta, meaning that is lower than 1, it means that it has a lower beta, it means that it also has a lower risk. So for example, let's look at these two stocks, the one which is called Anglo American Platinum and the other one which is called Impala Platinum, and as you can see that there are two different betas. The one has a lower beta and another one is a higher beta. And another thing which is highly recommended to investors is to highly look into stocks which have higher beta, because that basically means that they have a higher risk, and although they have a potential to actually make you lots of money, they also have a potential to actually take all of your money. And another thing to look into lower beta stocks, because lower beta stocks mean that they are most likely what we call defensive stocks. So defensive stocks are stocks which don't actually go according to the S&P 500 or a benchmark which has been set to them according to the other stocks which have like a higher beta. So actually look into lower beta stocks because they are actually going to be safe, and although they have short returns now in the future, that your money is actually safe, and you don't actually have to actually every time monitor them because of how lower their beta is. But compared to higher beta stocks, you always have to monitor how good they're doing or how nice or how bad they're doing, because your money is actually at risk. So actually look into that when you're actually going to look into comparing betas or when you want to research into stocks. Number 4, dividends. So if you don't like watching the market each and every day, you don't like doing all this technical analysis of like what stocks to buy and do all this research, don't get me wrong, everything that I've said until this point is very correct. But if you're a person who just doesn't like doing all this research and wasting time, or you feel like it's just wasting time, then I highly suggest you to invest into dividend stocks, because dividend stocks are very, very highly recommendable to people who feel like they don't want to do all these type of things and they just want to get money. So dividend stocks is just like getting interest in your savings account. You get paid regardless of whether the stocks are going up or down. The only thing that you need to monitor is the dividend yield of how much percentage is the company actually going to be paying out, and also how much are they actually going to be paying you. So dividend stocks, for those who don't know, or dividends for those who don't know, is money which is paid down to shareholders, which is decided by the directors of the company of how much the company has actually accumulated over the past 6 months, over the past year. So they actually decide on how much the company is actually been doing for over the past period of like 6 months or the financial year, and also they decide on how much money they're actually going to be paying out their dividend shareholders. So that's basically that. So I highly suggest you guys to look into dividends if you're a person who just doesn't like going to the markets every day and doing all this technical analysis. And I've made a video right here where I talk about the stocks which pay out dividends each and every month. So I highly suggest you to watch this video right here, because that is where I get into depth, where I talk about dividends, when I talk about stocks and all the type of things. So I highly suggest you to watch this video right here, guys, because this video is going to be very, very informative to each and every person, especially if you're a person who wants to invest in dividend stocks and who just wants to get paid every month or every day just because they invested their money in dividend stocks. Number 5, the chart. So there's a variety of stock charts which every person can actually use. We are called the line charts, the bar charts, or actually candlestick charts, and all of these charts are actually used by fundamental and technical analysis to make them make proper decisions when they actually want to buy any stocks or any crypto or any assets which may be worth an investment. So these are very, very important, and a lot of people feel like these charts are very easy, but they're very, very hard to actually read, and it actually takes a lot of time and skill to actually start acquiring how to learn this type of charts. Although it's very complicated to start learning how to read the line charts or starting to read all the investment charts, but there are two basic ways in which a retail investor can start actually reading the charts. So the first way is that if an investment chart starts on the lower left and goes on the upper right, that's a very, very good thing. And if a investment chart rather starts in the upper left and goes on the lower right rather, that's a very, very bad investment. And don't go into the details of finding out why the chart doing bad and all the type of stuff, because you may not have all the financial tools that other technical analysts actually do. Okay, so as I've said before, that there's a lot of stocks in the stock market which can actually make you lots of money. And if you're a person who just like investing in those stocks because you know the risk and because you've done the proper analysis and you've done the basic fundamentals, which you probably can do, then I highly suggest you to buy those stocks. But if you're a person that you also like investing in scary charts and you look at those people and you're like, okay, I can also invest in these things, don't do that, because you probably don't have the fundamental and the technical skills that these people do, and they know the reason why they do that, and you probably don't know why you're actually investing in those companies in the first place. So I highly suggest you to do that. And also, as I said before, that as a retail investor, try to acquire a skill of learning how to read charts, because that's going to be very, very essential when it comes to researching or when it comes to doing all this technical analysis if you want to buy stocks in the future. So with all that being said, investors still make a lot of mistakes. So that's why I created a video right here talking about the top 5 mistakes which each investor make and how to actually avoid those mistakes. So I highly suggest you to watch this video right here, right now.